Hello everyone, this is ACC Amit Kumar and we'll understand the intra-group transactions in group accounting, which is covered mainly through Ind AS 1110 consolidated financial statements. Now when we are consolidating the financial statements of two entities, we are treating them as a single entity. So single economic entity concept is applicable. Wherein we treat the results of two financial statements as one. So for the outside entity, the group will be considered as one. So if there are any intra-group transactions, the first intra-group transaction is when we are acquiring another entity. We record it as investment in subsidiary. On the other side, what we have acquired is we have acquired the entity acquires the net assets on the date of acquisition. So the first intra-group transaction is this, which we eliminate with the principle. So the principle to be followed is asset of one entity and liability of another gets cancelled on consolidation. One. Second, intra-group transactions are eliminated in full because they inflate the revenue, they inflate the cost of sales. So first transaction is when we are acquiring another entity, that is an intra-group transaction with which the journey begins of preparing consolidated financial statements, that if we have a subsidiary, on the last day of the reporting date, we are required to present consolidated financial statements. The second is sales of goods between parent and subsidiary. This also results in treatment of unrealized profit on sale of goods. Third is transfer of non-current assets between parent and subsidiary. Treatment of unrealized profit on non-current assets transfer. Next is goods in transit, cash in transit, so these are some of the intra-group transactions or intra-group loans between parent and subsidiary. So in some of the cases it is quite straightforward that we eliminate asset of one entity and liability of another on consolidation and they are eliminated in full. This is the principle we need to follow or we need to remember while consolidating financial statements. So how this investment in subsidiary in the parent's books, and subsidiaries books in the parent's books it is recorded as investment in subsidiary. In subsidiaries books it is share capital of parent, share capital of subsidiary, retained earnings on date of acquisition, any other components of equity on date of acquisition, so the amount being paid over and above the net assets is post acquisition profits of subsidiary. So on consolidation, parent plus subsidiary parent plus subsidiary, the investment in subsidiary over and above the net assets acquired, this gets cancelled with the investment in subsidiary. And the amount which replaces is goodwill. So this is asset of one entity indirectly and liability of another. So this is kind of a liability of entity is the reason this gets cancelled on consolidation with investment in subsidiary, and the only amount which is included, the investment in subsidiary on this side it is share capital of parent, retained earnings. So when we consolidate, we present share capital of parent only. We do not consolidate it with the share capital of subsidiary because that gets cancelled with the investment in subsidiary. That is cancelling because of the principal asset of one entity and liability of another gets cancelled on consolidation. This share capital of subsidiary is cancelling with the investment in subsidiary. The retained earnings position on date of acquisition is cancelling with the investment in subsidiary. Any other components of equity they are cancelling. Is the reason we include only post acquisition earnings. So if this amount is higher on cancellation, suppose the investment is 5 lakh and the total of these net assets is 4 lakh, so we may have a goodwill of 1 lakh presented as part of the balance sheet. This is resulting in goodwill. This differential amount is goodwill actually on consolidation. The difference between investment in subsidiary and the net assets acquired on the date of acquisition, the difference is goodwill which is presented on consolidation, and also as a result of asset of one entity and liability of another gets cancelled on consolidation is the reason we include only share capital of parent only, and we include group retained earnings. Group retained earnings is a combination of parent's earnings, that is parent's retained earnings, plus post acquisition profits of subsidiary. They are included as part of consolidated financial statement group retained earnings. So this is how we deal with the first entry which creates intra-group transaction, resulting in creation of goodwill, calculation of share capital of parent, And the single economic entity concept says that we are one. Single economic entity concept says that we are one. So we'll consolidate the results as if it is a single economic entity. It is one entity. Now to this objection that there is a non-controlling interest as well. So we say that everything belongs to us. Everything belongs to the group. We are controlling the assets. We are liable for the liabilities. We are the owners of this entity. Now, while presenting their net worth or net assets of the entity, they introduce the amount which is not belonging to them. They say that this is the amount which is not belonging to the group, which is belonging to third parties, and they are known as a non-controlling interest. NCI is presented separately in the consolidated financial statements. If there is any loan between two parties, parent shows loan receivables, parent is showing as part of their assets loan receivables, and subsidiary is showing as part of their loan payables. So any intra-group loan on consolidation, whichever is higher, if they are of same amount, they get eliminated from both sides. Loan receivable is say 60,000 and loan payable if it is 80,000, so they may be liable to pay 20,000 to some other parties. So when they present on consolidation, the presentation is loan receivables. If it is presented at 60,000, we'll present minus 60,000, eliminated on the debit side. On the payable side, loan payables, if it is 80,000 and intra-group is only 60, so we'll eliminate intra-group transaction. Intra-group eliminated. This is how intra-group transactions are eliminated. Sale of goods between parent and subsidiary, transfer of non-current assets between parent and subsidiary, treatment of unrealized profit on non-current asset transfer. Now, on the face of the balance sheet, if there is any unrealized profit on sale of goods, the unrealized profit is in inventory. So one way is to remove unrealized profit on the face of the balance sheet. Suppose we have inventory, parent plus subsidiary inventories less unrealized profit. Whether parent selling to subsidiary or subsidiary selling to parent, either the unrealized profit is in the books of parent or either the unrealized profit is in the books of subsidiary. So we have no choice other than eliminating it from the inventory on the face of the balance sheet if we wish to remove that unrealized profit from the inventory. So if I divide it into two parts, like I draw a line below it is credit balance. Suppose this is representing the debit and this is representing the credit balance. On the credit side, either it will be removed directly from parents' earnings. If we remove it from parents' earnings, we have to remove it from working note number 5. And if you have to remove it from post-acquisition profits or subsidy, we have to remove it from working note number 2. Or we can directly do it on the face of the balance sheet. If we say less group retained earnings and less unrealized profit on sale of goods. If we directly reduce it from the face of the balance sheet, then the direction of sale is irrelevant. What does it mean? So an entity sold goods worth 25,000 for a price of 40,000. Half of the goods remain in inventory. So I say, instead of parent, I'll say subsidiary sold goods worth 25,000 for a price of 40,000. Half of the goods remain in inventory. So one thing is, in the balance sheet, it will be eliminated from inventory. P plus S minus unrealized profit is 7,500. Half of the goods remain in inventory means 15,000 was the profit. That means profit was 15,000, out of which unrealized is 7,500. The remaining 7,500 is sold to third parties. It is realized. On the other side, in the group retained earnings, we'll be adding the parents' earnings, and in it we'll add share of post acquisition profits of subsidiary. So when we include share of post acquisition profits of subsidiary, and if subsidiary has made its profit, then there is a working note known as working note number 2, net assets of subsidiary on date of acquisition and date of balance sheet. In which they are representing their share capital, retained earnings, fair value adjustments. In that, if there is any unrealized profit on sale of goods, that is eliminated on the date of balance sheet figure as minus 7,500, and we'll get the total on date of acquisition, date of balance sheet. The difference between them will be divided between parent and NCI share. The difference between them will be considered as post acquisition profits. Suppose this total is 3 lakh and this is 3,50,000. Post acquisition profit will be 350 minus 3 lakh. Will be considered post acquisition profit from subsidiary, in which parent and NCI has a share. So if subsidiary is selling to parent, it makes sense to eliminate it from working note number 2. So NCI in parent gets a share of the unrealized profit. Because if we deduct it directly on the face of the balance sheet, now if Suppose if parent has a share of 80% and NCA has 20%, this automatically 75 gets divided between 80 and 20. But when we treat it on the face of the balance sheet directly, the second choice is if you wish to treat it on the face of the balance sheet, this is also possible. In this case, direction of sale is irrelevant because you directly reduce it from group retained earnings. We are directly reducing the unrealized profit from the group retained earnings. So when we are directly treating it in the group retained earnings, we can remove the unrealized profit on the face of the balance sheet. We can remove it on the inventory side, directly unrealized profit. We can remove on the face of this balance sheet on the debit side, and this is the debit side of it, and this is the credit side of it. Debit removed, credit removed. So settled. If it is not considered much material, but if someone is very emotional and they wish to allocate it to NCI as well, then I recommend that please make the adjustment in working note number 2. Do not do it on the face of the balance sheet. Make the adjustment in working note number 2. Automatically post acquisition profits will have a share divided between parent and NCI. So when we make the adjustment in working note number 2, automatically it is divided between parent and NCI, the unrealized profit. Takes care of it. But if parent sells goods to subsidiary, then working note number 5 is group retained earnings. Group retained earnings represents parent's earnings. It represents share of profit from subsidiary belonging to parent. Now this share of profit from subsidiary, when subsidiary was selling to parent, if there was any unrealized profit, it got treated here, and this post acquisition profit is after eliminating unrealized profit automatically treated. But if parent sells goods to subsidiary, then that unrealized profit is in the parent's books. Unrealized profit on sale of goods to subsidiary. Unrealized profit on sale of goods to subsidiary. If that's the case, then whether we eliminate it in working note number 5 or whether we eliminate it in working note number on the face of the balance sheet, it doesn't make any difference. When parent sells goods to subsidiary, we eliminate it directly from group retained earnings on the face of the balance sheet, or we eliminate it in working note number 5, it does not make any difference, because we are eliminating it directly from group retained earnings, the unrealized profit on sale of goods by parent to subsidiary. When parent sells goods to subsidiary, the unrealized profit is in working note number 5. So this working note number 5 and 2 are indirectly, working note number 2 indirectly represents the income statement of subsidiary. Working note number 5 indirectly represents the income statement of the parent. So if the parent has earned that profit, we should remove it from working note number 5. And if subsidiary has earned that profit, we should remove it from working note number 2. That's the best way of doing it. But if in doubt, you can simply eliminate it on the face of the balance sheet by eliminating the inventories with unrealized profit on the debit, and credit, simply remove that unrealized profit from the group retained earnings. The job is done. If you do it in this manner, the direction of sale is irrelevant. You don't have to worry about the direction of the sale. So we were saying treatment of sale of goods between parent and treatment of unrealized profit on sale of goods. So on the face of the balance sheet, this is how it is to be done. In the income statement, the impact will be treatment of unrealized profit on sale of goods in income statement. Suppose this is parents' books. Subsidiaries books. Revenue, cost of sales, revenue, cost of sales. So assume parent sold goods worth 21,000 for a price of 30,000. All the goods remain in inventory. So when they sell to each other, what is the impact of it? The cost of sales of the parent was 21,000. They sold it for 30,000, which becomes the purchase price for subsidiary. Subsidiary purchased it for 30. Now this transaction has two things in it. We have to eliminate intra-group transaction. We also have to eliminate unrealized profit. There are two things into it. Now when we add up P plus S, revenue plus revenue, P plus S, when we add up revenue plus revenue, it turns out to be revenue of parent with revenue of subsidiary, it turns out to be 30,000. Cost of sales of parent plus subsidiary is equal to 51,000, that is 21,000 plus 30,000, it is 51,000. So we need to eliminate two things. One is intra-group transaction. The revenue is inflated by 30,000 because we cannot sell to each other. The cost of sales is inflated by 30,000, we cannot purchase from each other. One thing is this. Even if we remove this, we are left with 0. We are left with 21,000 of cost of sales. Now this cost of sales had that opening balance, opening plus purchases less closing stock. Opening balance was say nil, purchases was 30,000, less closing stock was 30,000. So this was representing the cost of sales. So there was purchases of 30,000, closing stock was 30,000. The cost of sales this year was nil, but there was an intra-group transaction. If you notice, the intra-group transaction was 30, was purchases was an intra-group transaction. We have to remove purchases. So resulting cost of sales turns out to be equivalent to 21 in the end. So if you noticed, if it was total revenue, suppose this entity was earning revenue of 200,000, it had cost of sales of 1,50,000, it had sold goods worth 150, cost of goods sold were 120,000, if that's the case. Then the cost of sales figure, suppose, would have some opening balance. The opening balance was, say, 80,000 plus purchases 100,000, closing stock 60,000. We got cost of sales of 120. So when we do P plus S, it turns out to be equivalent to 2 lakh plus 150, and cost of sales is equal to 150 plus 120. And if this transaction has taken place, parent sold goods worth 21,000 for a price of 30,000. So that cost of sales was 21, indirectly it was 21, it was sold for 30, and they had purchased it for 30. This is what has happened. And it remained in the closing stock at 30. It was removed as well from the cost of sales figure. This is happening at the back end when we are dealing with intra-group transactions. So on the face of the balance sheet, or on the face of the income statement, we need to remove this intra-group transaction because this is inflating the revenue. This is unnecessarily inflating the revenue because from the group's perspective, we are selling the goods which were worth 21,000 for a price of 30,000. We are generating a revenue. Revenue is inflated by 30. This entity purchases for 30. The purchases are inflated by 30. So unnecessarily the purchases are inflated, the revenue is inflated when the cost of purchases was only 21,000 for this entity, and that too remains in inventory. That too remains in inventory. So in inventory it is being recorded at 30. The inventory is recording it at, in the balance sheet, inventory is recording it at 30,000. Plus, this entity has made a profit by selling for 30,000, goods for 21,000. They made a profit of 9,000, which is not realized yet. Which is inherent in this? This 9,000 is the unrealized profit. Unrealized profit is 9,000 into it. There is an unrealized profit into it worth 9,000. They purchased it for 30. They removed it from here from 30 and could not sold it anything further. So this has resulted in valuing the closing stock at 30. This has resulted in valuing the closing stock at 30,000. So we need to do two things. One, revenue is inflated by 30. One, purchases are inflated by 30. So we need to eliminate this. This 30 we are eliminating from the consolidated financial statements. We eliminate 30. So purchases get eliminated. This is getting eliminated, 30. This is already removed from here. And this forms part of inventory. From this inventory, we will be removing 9,000 less 9,000 on the face of the balance sheet, and this is happening on the credit side, that is on the income side. How we'll remove it? That is the second step. First, let's eliminate intra-group transaction. So eliminating intra-group transaction, which is inflated. How we are eliminating intra-group transaction? We remove revenue by 30. We decrease the cost of sales by 30 because this cost of sales has purchases which is inflated by 30. Purchases is inflated by 30. So we remove intra-group transaction. This is how intra-group transaction is eliminated. This is how intra-group transaction is eliminated. Now this intra-group transaction has an unrealized profit of 9,000 which also need to be removed. How to remove it? To remove unrealized profit, now eliminate intergroup transaction, remove from revenue and cost of sales intragroup transaction. Elimination of unrealized profit is either increase cost of sales or reduce unrealized profit directly from gross profit. So one way is to increase the cost of sales. If you increase cost of sales here by 9,000, the gross profit is, say, the gross profit is equal to 320 minus 240. One way is to remove 9,000 from unrealized profit from here. $80,000 minus 9,000. This is the profit after adjustment. Or the other way is to increase the cost of sales by unrealized profit plus 9,000, then compare 3,20,000 with 249,000 and arriving at gross profit at 320 minus 249, 71,000. So do not do both. Either remove directly, this is removing directly from gross profit, and this is adding as part of cost of sales. Use either of the two. Either do this or do this. So we have to do two things. One is eliminate intragroup transaction. So this is elimination of intragroup transaction. This green is elimination of intragroup transaction. And this is elimination of unrealized profit. One method. The second method is increasing the cost of sales. So this is the accounting treatment in the income statement. On the face of the balance sheet, the inventory will be reduced by 9,000. In the income statement, this will be removed either by increasing the cost of sales or either removing directly from the gross profit, so the unrealized profit gets treated. This is how we deal with treatment of unrealized profit on sale of goods in income statement. Intra-group transfer of non-current assets. In intra-group transfer of non-current assets, suppose parent sells a machine worth 100,000 for 150,000. The useful life of the machine, the remaining useful life of the machine is 5 years. It was depreciated at an amount of 20,000. Depreciation by subsidy is recorded as 1,50,000 divided by 5. They have recorded depreciation of 30. Depreciation by parent before transfer, it was 20. So one is excess depreciation in books of subsidiary, which we need to remove, that is 10,000. Excess depreciation we need to remove, which is 10,000. So as far as our workings are concerned, we will make the adjustment in working note number 2. We'll add back the depreciation charge to net assets on date of balance sheet. This adjustment, and parent records profit of 50,000, so need to make the adjustment in working note number 5. Profit on sale of machine eliminated in working note number 5, group retained earnings. So if you're adjusting working note number 5, then in it excess depreciation reversed, and we reverse excess depreciation means we add back 10,000 on the date of balance sheet. Working note number 5, group retained earnings. Add back unrealized profit on sale of machine to subsidiary. Minus 50,000. It may happen opposite. If subsidiary sells machine worth 100,000 to parent, if it is opposite, I'm just assuming if it is opposite, if subsidiary sells, then if subsidiary sells machine to parent, then the profit on disposal of machine, which is unrealized, this 50,000 will be removed from the face of the balance sheet. And if subsidiary sells machine to parent, the excess depreciation is in the books of the parent. So add back excess depreciation charge to machine 10,000. This is when subsidiary sells machine to parent, non-current asset transfer. This is how non-current asset transfers are treated. This is how non-current asset transfers are treated. Dealing with goods in transit and cash in transit. Goods in transit and cash in transit. Parents and subsidiary have outstanding balances against each other. Parents' books, subsidiaries' books, trade receivables, 60,000, trade payables, $50,000. So difference could be because of two reasons. Either parent delivered goods not received by subsidiary, or either subsidiary made the payment not received by parent. Parent delivered goods not received by subsidiary. These are goods in transit, and this will be cash in transit. So if we deal with goods in transit, we assume as if the goods have been delivered. If we assume as if the goods have been delivered, then the balances will be inventories account, debit, credit, trade payables, 10,000, 10,000. The resulting balance is 60,000. The second step is eliminate intra-group transactions. The second step is eliminate intra-group balances on consolidation. Asset of one entity and liability of another gets cancelled. So the treatment will be less 60,000, less 60,000, eliminated. So first we need to bring them at par, treat goods in transit, and then we need to eliminate intra-group transaction. So we have to perform two calculations. One, dealing with goods in transit, and second, elimination of intra-group transactions. So first we dealt with goods in transit by passing this entry. The second scenario could be cash in transit. Cash in transit. If that's the case, this entry will shift to parent side. And it will be cash account debit 10,000 and trade receivables count credit 10,000. Assume as if cash has been received. This was assume as if goods have been delivered. So cash in transit, receivables 60, payables 50. When we pass these transactions, the receivables also reduced to 50,000 and payables are already at 50. Receivables reduced to 50,000, payables are already at 50,000. So first treatment is dealing with cash in transit. We assume as if cash has been received, so receivables reduced by 10. The balances are at par. Outstanding balances between parent and subsidiary are at par 50-50. The second thing to be done is eliminate intra-group balance on consolidation. That is, asset of one entity and liability of another gets cancelled on consolidation. Now we need to eliminate receivables and payables from both sides. 50,000 minus 50,000. Trade payables 50,000 minus 50,000. So when there is a difference between intra-group balances, we should know the information whether it is because of delivery of goods or either because of cash payment. So if there is a difference between receivable and payable, it could be result of goods delivered by parent or it could be result of subsidiary made the payment. It can be vice versa as well. So depending on the information provided to us that it is sale of goods or it is the payment was made, we treat the goods in transit and cash in transit as if they have occurred. So this is done on the assumption. What if the goods have been received? We'll debit the inventory, credit the payables. If goods have been received by the subsidiary. Once this is done, goods in transit is dealt with, we need to deal with intra-group balance as well. That is the second step to be done. Please do not forget. These are two steps involved in cash in transit and goods in transit. If there is cash in transit, if there is a difference, one of the entity had made the payment, the other party did not receive it. So we'll assume as if the cash has been received and we'll make the transaction receiving the cash, debiting and crediting trade receivables. So we were successful in bringing the payable and receivable at par after adjustment of cash in transit. Once this is done, we need to eliminate asset of one entity and liability of another on consolidation. So this is how we deal with intra-group transactions. I hope it is clear with everyone. We assume that the group is a single economic entity, and we dealt with the first major transaction was creation of goodwill by eliminating investment in subsidy with the net assets acquired on the date of acquisition. This is also intergroup balance, need to be eliminated on consolidation, and we create goodwill. So this concept is asset of one entity and liability of another gets cancelled on consolidation. Second, we dealt with sale of goods between parent and subsidiary. If parent sells goods to subsidiary, make the adjustment in working note number 5. If subsidiary sells goods to parent, make the adjustment in working note number 2. On the face of the balance sheet, we need to eliminate unrealized profit from inventory. Direction of sale is irrelevant in this case. When we are transferring non-current assets between parent and subsidiary, if parent sold the asset to subsidiary, parent has made the profit. Need to eliminate it from working note number 5, group retained earnings. Subsidiary is recording the machine at a higher price. They need to eliminate excess depreciation. If subsidiary sells to parent, then subsidiary has made the profit, make the adjustment of profit in working note number 2. Parent is recording higher depreciation, make the adjustment of excess depreciation in working note number 5. So we need to see where the depreciation is being recorded, which entity has recorded the profit, unrealized profit. Goods in transit and cash in transit, we assume as if the goods have been received or delivered. Cash in transit, the payment has been made or received by the receiving entity on the assumption that it is received. If there is any intra-group loan between parent and subsidiary, that intra-group loan to the extent of intra-group balance, not the loan with third parties, is eliminated on consolidation. So when there are intra-group transaction, if there is any sale which is to third parties, that gets realized, then there is no unrealized profit. Now if this is the case, if the sale is realized, if the profit is realized, then what happens? Goods worth 21,000 sold for 30,000. They were part of purchases, opening less closing stock. They became part of cost of sales as well. And they were sold for say 42,000. So the 21,000 worth of goods were sold for 30, they were received by 30 and were sold for 42. So when we do P plus S, it is 30,000 plus 42,000. Cost of sales is 21,000 plus 30,000. When we eliminate intra-group transaction, we get the real result, that is 72 minus 30, and we get 51 minus 30. So the profit is equal to 42 minus 21. The profit is realized. How much profit realized? They recorded a profit of, they recorded a gross profit of 9,000. They recorded a gross profit of 12,000. Total profit realized by the group is 21,000. This is when there is no stock, the profit gets realized immediately. So if you notice here, this revenue 30,000 gets cancelled with this cost of sales 30,000. Indirectly, the revenue earned by the group is 21,000 worth of goods were sold for 42. So they earned a profit of 21,000. So when it is realized, then there is no problem. But if it is eliminated in closing stock when calculating the cost of sales, then there is a problem. Cost of sales is a combination of opening stock plus purchases less closing stock. This is how the cost of sales figure is calculated. So this is all for intra-group transactions. So you can have a look at more insights on Ind AS through the lectures delivered on Unacademy, and use the code ACCA Amit to subscribe any course on Unacademy to get instant discount. If I share about my brief, I've been training on IFRS Ind AS since 10 years now, and I'm also an author of a book on Ind AS known as Ind AS Concepts in One Day. And I have served corporates in the last 10 years, was one of the first IFRS trainers in the country, teaching since 2009, and have led IFRS trainings at KPMG, was one of the lead trainers at KPMG Delhi as well as Mumbai, traveling the length and breadth of the country in the last 10 years. Until recently, I was the director with Accounting Advisory Services Video India. To learn more, follow me on Unacademy and also have a look at the insights shared on the YouTube channel on Unacademy, on the special classes. And to have a detailed knowledge, subscribe to the course on Unacademy using the code ACCA Amit. So this is all for the day. Thanks for your valuable time. See you again.